All right, today we're diving into a real head-scratcher from the market. How in the world did two companies known for selling groceries and, giant packs of toilet paper suddenly get valued like they're the next big thing out of Silicon Valley? It's a true retail tech anomaly, and we're going to break it down.
So, let's set the scene. It's March 2026, and something really weird is happening on Wall Street. All of a sudden, investors are looking at companies like Walmart and Costco, and they're not just seeing stores anymore. No, they're seeing something completely different. The entire narrative is changed.
And, just look at these numbers. You've got Costco trading at a forward PE ratio of around 54 and Walmart at 44. To put that in perspective for you, those aren't retailer numbers, those are tech numbers. That's the kind of price you pay for a super fast-growing software company, not a place you buy milk and eggs. The market is paying a huge premium here.
Which of course brings us to the big question, right? How did selling cans of soup get valued like selling software? How on earth did we get here? Well, that's exactly what we're about to figure out.
All right, let's get into the investigation. The bull case, the big story behind these wild valuations, is something Wall Street is calling retail's new tech playbook. And the core idea is that these companies aren't just plain old retailers anymore.
This whole playbook really comes down to three key things: the membership model, a massive ad machine, and a super powerful AI engine. Let's tackle them one by one.
Okay, so pillar number one is this concept called membership as a service. And this is a really powerful idea. Basically, the market stopped looking at a Costco membership as just a fee to get in the door. Instead, they see it as a guaranteed recurring revenue stream, kind of like a software subscription. Think Netflix, but for bulk paper towels.
And you can see why this is so appealing. Look at that renewal rate in the US, an incredible 92%. When you have that kind of loyalty, your revenue becomes super predictable, super stable. And that's exactly the kind of thing investors love to pay up for. And you know what? Walmart is chasing this exact same model with Walmart Plus.
Now, the second pillar, this is where things get really interesting, really techy. These companies figured out that their most valuable product isn't actually on the shelves. It's the data, specifically the data on what you're about to buy. So they're making this huge shift from just selling you stuff to selling access to you, to other brands.
And here's why that shift is a total game changer. Look at the profit margins. Advertising, we're talking something like 75%. Selling groceries, you're lucky to get 4%. So as Walmart's ad business gets bigger and bigger, it completely transforms their bottom line. It's turning a classic low-margin business into a high-margin tech platform.
And that brings us to the third piece of the puzzle, the AI engine. And really, this one number tells you everything you need to know. 35%. That's how much bigger the shopping baskets are for Walmart app users who use their little AI agent. So you see, AI isn't just some buzzword they're throwing around, it is directly making them more money.
And it goes way deeper than just the shopping app. We're talking 40% of all new code at Walmart is now AI supported. They've got these so-called super agents running their supply chain. They're aiming for 65% of their stores to be serviced by automation. The goal here isn't just to save a few bucks, it's to build tech-level efficiency right into the DNA of the company. That's how you get profits to grow way faster than your sales.
Okay, so that's the story the bulls are telling. And you have to admit, it's a pretty compelling one, right? But here comes the twist. Because when you pay a tech company price for a stock, you also get tech company risks. And the number one risk here is that the price, well, it assumes absolute perfection.
And this leads us to the biggest danger of all, a concept called multiple compression. And you really got to understand this. It means the company can do everything right. Sales are up, profits are up, but the stock price can still go down. Why? Simply because the market decides it's just not willing to pay that super high premium anymore.
And this chart shows you exactly what that risk looks like in the real world. Think of it like gravity. Right now, Walmart's PE is floating at twice its 10-year average. If investors' feelings change and that multiple just falls back to earth, back to its normal level, the stock price could literally get chopped in half. And that could happen even if the business itself is doing great.
So here's the bottom line. When a stock is priced for perfection, there's absolutely no margin for error. A tiny little stumble, like, say, membership renewals dip by just 1%, could cause a huge sell-off. You're basically paying today for 10 years of perfect execution. No mistakes allowed.
And that leads to the other huge risk. A question every single investor has to ask themselves. Is this really the best, safest place for my money right now? Especially when you look at the alternative.
This really lays the problem out, doesn't it? If you look at Costco's earnings yield,
which is just the flip side of its PE ratio. You're getting about 1.8%. At the same time, you could buy a government bond, take on basically zero risk, and get a 5% yield. You have to wonder, at what point do the big money investors just say, you know what, the risk here just isn't worth it?
All right, so let's put it all together. What's the final verdict? Are we looking at a brilliant new kind of company or just a really dangerous trap?
This table really nails the central conflict. The promise is a tech multiple, but the problem is you're still only getting retail growth. You're paying a tech price, but the underlying business doesn't grow like a tech company. The two just don't match up.
And this is what some people are calling the worst of both worlds trap. And it's pretty much exactly what it sounds like. You're paying the price of a high-flying tech stock, but what you're actually getting is the growth rate of a good old physical retailer. You're paying for speed, but getting size. So that's where we land, with a huge, unanswered question. Are these companies the future, brilliantly disguised as tech? Or are they just caught in a bubble, priced for a perfect future that might never arrive? How this plays out is really going to define the next chapter for these giants. Thanks for tuning in.